There are days in markets when the numbers tell you a cleaner story than the headlines. The headlines say some stocks were crushed, some stocks were rewarded, some stocks disappointed, some stocks surprised. But underneath that surface there is a deeper pattern, and that pattern is what serious investors have to pay attention to. The pattern is this. Artificial intelligence is now forcing the largest technology companies in the world to spend at a level that would have looked insane only a few years ago. Some companies can clearly explain that spending because it is already turning into cloud revenue, infrastructure demand, and visible business growth. Other companies are spending aggressively, but the market cannot yet see the return clearly enough. That distinction matters. The market is not simply rewarding AI spending. The market is rewarding AI spending that has an obvious business line attached to it. When Amazon spends heavily and AWS growth accelerates, investors understand the connection. When Google spends heavily and Google Cloud grows at extraordinary rates, investors understand the connection. When Microsoft spends heavily and Azure continues growing strongly, investors understand at least part of the connection. But when Meta spends massively and the explanation is less direct, investors become more skeptical. This is not because Meta is a bad company. It is because the market wants to know the cause and effect chain. Money goes in. Where does the return come out? That is the question. And in this market, that question matters more than the narrative. AI is not enough as a word. CapEx is not enough as a signal. Ambition is not enough as a reason. Investors want evidence that the spending is turning into durable revenue, stronger margins, and future cash flow. That is why a day like this becomes useful. It separates companies that can justify heavy investment from companies that may still be right in the long run but are entering a period of pressure before the payoff becomes obvious. As an investor, I always want to look beyond the immediate price move. A stock falling after earnings does not automatically mean the business is broken. A stock rising after earnings does not automatically mean the stock is cheap. The market reacts to the difference between expectation and reality. It also reacts to the quality of the numbers, the quality of the explanation, the credibility of management, and the visibility of future returns. That is where the opportunity is. Not in reacting emotionally to red and green, in understanding what the market is really repricing. Let us begin with Meta. Meta reported very strong revenue growth. Revenue rose at a rate that would be excellent for almost any mature business in the world. Among the major technology companies, it remains one of the strongest revenue growers. And that should not be dismissed. A company with billions of users, mature platforms, and already enormous scale growing revenue above 30% is not ordinary. That tells you Meta's core advertising machine is still powerful. It tells you the company still has enormous reach. It tells you the business is not dead. But revenue growth is only one side of the system. The expense structure is the other side, and this is where the problem appears. Cost of revenue grew faster than revenue. Research and development grew much faster than revenue. Total expenses grew at a pace that consumed much of the operating leverage the market wanted to see. Operating income grew, but not faster than revenue in the way a high-quality technology business should ideally show when it is scaling well. That matters. If revenue rises 33% and expenses rise even faster, the company is not getting the kind of leverage investors want. A great business should ideally be able to grow revenue while profits grow even faster. That is operating leverage. That is the reward for scale. That is what makes a platform business so powerful. But Meta is entering a period where spending is so large that leverage is being suppressed. The income statement therefore deserves respect but also caution. It is not a disaster. It is not an A+. It is a good business showing very real cost pressure. That is the right way to read it. The market also noticed something else. Daily active people declined sequentially. Management may have reasonable explanations. War disruptions, restrictions, regional access issues, and other temporary factors can affect usage. But as an investor, I do not want to see user engagement move backward in a platform company. For a platform of Meta's size, user growth will naturally be slower. That is expected. But declining active people creates concern because the user base is the foundation of the advertising engine. The market can tolerate slower growth. It becomes more nervous about decline. Even if the explanation is temporary, the signal is not something to ignore. Then there is CapEx. This is the real issue. Meta has taken capital spending to an extraordinary level. The company was already spending aggressively, and then management raised the range even further. The numbers are large enough that investors are no longer simply asking whether Meta believes in AI. Everyone knows Meta believes in AI. They are asking whether the spending is disciplined. They are asking whether the incremental dollar of spending creates enough incremental revenue or enough future strategic advantage to justify the cost. That is a much harder question. This is where Meta is in a difficult position. Everyone understands why Amazon needs to spend on AWS. Everyone understands why Google needs to spend on Google Cloud. Everyone understands why Microsoft needs to spend on Azure. But with Meta, the spending is partly about AI infrastructure for advertising, content recommendation, user engagement, llama models, future products, and possibly long-term platform control. Those may all be important, and Zuckerberg may ultimately be right. But the market cannot yet see the same clean revenue line that explains the spending. That is why the stock is vulnerable. Meta may be making the right long-term decision and still experience a painful stock repricing in the short and medium term. Those two things can both be true. This is one of the most important investing lessons. A company can be strategically right and tactically punished. If the market cannot see the return on investment clearly, it may not give management the benefit of the doubt forever. Zuckerberg has done this before. He has spent aggressively, he has pushed into areas that the market hated, he has taken the pain, and in some cases he has later proven investors wrong. That is why it is dangerous to underestimate him. But the path between now and the eventual outcome can be ugly. The stock can fall, multiples can compress. Earnings estimates can come down, investors can demand spending discipline, free cash flow can come under pressure, and at some point, if the stock is punished hard enough, management may be forced to moderate spending, just as happened in prior cycles. That is the likely mechanism. The market may become the discipline mechanism. This does not mean I would dismiss Meta long term. A great company can go through a messy period, but I would not ignore the spending problem. It is real. It may get worse before it gets better, because the cost of these AI investments will hit multiple line items over time. CapEx today can become depreciation tomorrow. Infrastructure spend can become operating pressure later. Talent costs can rise. R&D can keep growing. The income statement can become heavier before the strategic payoff becomes obvious. That is why Meta is not a simple story right now. The core business is strong, the spending is intense, the user number created concern, the market wants proof. Until that proof is clearer, volatility should not surprise anyone. Now contrast that with Amazon. Amazon reported an income statement that was much easier for investors to understand. Revenue grew strongly, cost of sales grew slower than revenue, fulfillment grew slower than revenue, sales and marketing remained controlled, general and administrative expense even improved. Operating expenses rose, but not faster than sales. Operating income grew much faster than revenue. That is what investors want to see. That is operating leverage. Amazon is spending heavily too, especially in technology and infrastructure. That line item is pressure. It will likely remain pressure because AI and cloud infrastructure are not cheap, but Amazon has a clear business line that explains why the spending is necessary. AWS is the key. When AWS revenue growth accelerates to its fastest rate in years and beats Wall Street expectations, the market understands why Amazon must spend. AWS customers need compute, they need infrastructure, they need cloud capacity, they need AI capacity. Amazon is not spending into the fog, it is spending into visible customer demand. That is a very different situation from spending that investors cannot clearly map to revenue. Amazon can say, our customers need us to build capacity. Investors can see the AWS growth rate, they can connect the dots. That gives management credibility. The advertising business adds another layer. Amazon's advertising segment has become a third giant inside the company. It is growing quickly, it is highly profitable, and it benefits from Amazon's control of commerce intent. When users search for products on Amazon, advertisers want to appear at the point of purchase. That is valuable. So Amazon now has three engines: the original e-commerce and marketplace engine, the cloud engine, the advertising engine. Each reinforces the larger platform. This is why Amazon is such a powerful long-term business. For years, people underestimated Amazon because they looked at thin retail margins and missed the way the business was building infrastructure, logistics, third-party marketplace power, cloud dominance, and advertising scale. Amazon has always been a company willing to sacrifice short-term profit to build long-term power. The difference now is that investors can see multiple profit engines maturing. That is why heavy spending is easier to accept. If AWS growth continues accelerating into the 30s, the market will allow Amazon to spend aggressively. Not forever, without question, but with much more tolerance than it will give to a company where the return is less visible. The lesson is not that spending is good or bad. The lesson is that spending must be explainable. If a company spends $200 billion and shows you exactly which business line is accelerating because customers are demanding that capacity, investors may accept it. If a company spends $140 billion and investors cannot clearly see the incremental return, they will become more nervous. This is the same principle in household finance, business finance, and national finance. Debt or spending tied to productive assets can create future value. Debt or spending without clear productive return creates fragility. Amazon's case is more credible because the cause and effect chain is clearer. Now let us look at Google. Google delivered an exceptional income statement. Revenue grew strongly for a company of its size and maturity. Cost of revenue grew slower than revenue. Total cost and expenses grew slower than revenue. Operating income expanded faster than revenue. Earnings were very strong, even if there were one-off items that made some bottom-line numbers look more dramatic than the core business alone would suggest. The key is the same as Amazon: Google Cloud. Google dramatically increased capital expenditure. And normally the market would punish a company for that, but Google Cloud grew at a remarkable rate. The cloud business is now large enough to matter and growing fast enough to justify the spending. This is the crucial difference. When Google says it needs to spend more on data centers, chips, servers, and AI infrastructure, investors can look at Google Cloud revenue and say, we understand. The business is accelerating, the customer demand is visible, the spend has a home. That is why Google can raise capex and still be rewarded. The market is not blindly accepting AI spending, it is accepting AI spending where there is an identifiable return path. Google also has other advantages. Search remains powerful, YouTube remains powerful. Android cloud, AI models, enterprise services, and advertising create an ecosystem with extraordinary reach. But the market today is focused heavily on whether Google can defend and grow in the AI era. Google Cloud growth gives investors evidence that the company is not being left behind. Still, valuation matters. A stock can be a great business and not a great buy at every price. If Google has already moved dramatically, the easy money may be behind it for now. There can still be momentum. There can still be long-term strength. But the forward return may be less attractive after a large move than it was when the market was worried and the stock was much cheaper. That is another principle. A good company is not automatically a good buy. Price matters, expectation matters, the risk. Reward changes as the stock moves. A disciplined investor distinguishes between business quality and investment opportunity. Google may remain a great business and a hold for long-term investors, while no longer being the most attractive fresh buy compared with other opportunities. That distinction is important. Now, Microsoft delivered a very strong income statement, though not as cleanly perfect as some might want. Revenue grew well, certain cost lines grew faster than revenue, but research and development, sales and marketing, and general administrative costs were kept under good control. Operating income grew faster than revenue. Net income grew faster than revenue. That is the operating leverage investors want. The main issue is Azure. Azure growth remains strong, but the question is whether it is accelerating enough compared with AWS and Google Cloud, where the acceleration was especially noticeable. Azure's growth looks strong but less surprising. It is not weak, it is just not delivering the same kind of upside surprise in the growth rate. Microsoft is also increasing capital spending aggressively, partly because memory prices and AI infrastructure demand are rising. This has direct implications for the companies supplying the hardware behind AI. This may be the most important conclusion from the big technology earnings cycle. When Meta, Amazon, Google, and Microsoft all raise or maintain enormous capital spending plans, the most direct beneficiaries may be the chip and hardware suppliers. NVIDIA, AMD, Micron. Companies like these are positioned to receive the money. The cloud and platform companies are spending, the suppliers are selling. That is the difference. If Amazon, Google, Meta, and Microsoft are fighting to build AI infrastructure, then someone must provide the GPUs, accelerators, memory, networking, and related hardware. That money does not vanish. It flows into the semiconductor ecosystem. That is why the next 12 to 18 months may continue to favor chip. Related names, the large platform companies may face pressure from spending, depreciation, and questions about return on investment. But the chip companies are the recipients of that spending. When capital expenditure rises across big tech, NVIDIA, AMD, and Micron benefit directly. This is a very important cause and effect chain. AI ambition creates cloud and data center spending. Cloud and data center spending creates demand for chips, memory, and infrastructure. The companies building the end-user platforms may eventually capture enormous value, but in the near term, the suppliers may have clearer revenue visibility. That is why someone looking at the next year or year and a half may be more confident in the AI hardware suppliers than in every mega-cap platform stock. This does not mean chip stocks are risk-free. They can become expensive, demand can be cyclical, customers can eventually moderate spending, margins can fluctuate, competition can rise, export restrictions and supply constraints can matter. But as long as the biggest companies in the world continue increasing AI capex, the semiconductor supply chain remains in a powerful position. This is where the money is going. Again, follow the money, not the narrative. The narrative is AI, the money is flowing into chips, memory, servers, data centers, power, cooling, and cloud infrastructure. That is where investors must look. Now let us turn to Cheesecake Factory. At first, it may seem strange to put Cheesecake Factory in the same discussion as Meta, Amazon, Google, Microsoft, NVIDIA, AMD, and Micron. But that contrast is useful. Cheesecake Factory does not need to spend tens or hundreds of billions on AI chips. It does not need to justify a data center build-out. It does not need to explain why capex is exploding. People want food, they want a dining experience, they want value, consistency, and a place to go. That simplicity has value. The income statement was strong, revenue grew, food and beverage costs improved as a percentage of revenue, labor costs improved. Some operating expense lines were not perfect, but overall profitability improved. Net income and earnings per share expanded significantly, helped by the absence of certain prior year one-off costs. This is not a company trying to become the operating system of AI. It is a restaurant company with brands, unit growth potential, dividends, and a long runway through concepts like North Italia, Flower Child, and others. The market often underappreciates these kinds of businesses because they are not glamorous. But a stable business with expansion potential, dividends, and a reasonable valuation can be attractive. Not every investment needs to be a technological revolution. Some investments are powerful because they are understandable, profitable, and disciplined. A restaurant business has its own risks. Food costs, labor costs, consumer spending, leases, competition, and execution all matter. But compared with big tech SAI spending arms race, the business model is far simpler to analyze. That simplicity can be comforting in a market where every mega-cap technology company is making massive infrastructure bets. Cheesecake Factory may not have the upside of a major AI winner, but it also does not face the same uncertainty around AI capex depreciation cycles and whether hundreds of billions of dollars will generate acceptable returns. That is why a portfolio can benefit from different kinds of businesses. Some growth, some stability, some cash flow, some dividends, some innovation, some resilience. The goal is not to own only one kind of company. The goal is to understand what role each company plays. Now, after reviewing the major earnings, we come to the central opportunity in the source SoFi. SoFi fell sharply after earnings, and that is exactly the kind of moment that can separate short-term traders from long-term investors. The stock was hit hard, but the underlying numbers were very strong. Total interest income grew substantially, interest expense grew slower. Net interest income expanded, non-interest income grew strongly. Loan origination, sales, securitization, and servicing revenue increased dramatically. Loan platform fees rose. Total net revenue grew more than 40% year-over-year. Income before taxes surged. Net income rose more than 100%. Earnings per share doubled. Those are not weak business numbers. They are the numbers of a company scaling. So why did the stock fall? Because stocks do not move only on the absolute numbers. They move on expectations, positioning, valuation, risk appetite, guidance, and sentiment. If investors were expecting perfection, even a strong report can be punished. If a stock had run before the report, traders may sell the news. If the market is nervous about financial companies, lending risk, or macro conditions, the stock may fall despite strong growth. This is why price movement after earnings can be misleading. A falling stock can have strong fundamentals. A rising stock can have weak fundamentals. You have to read the business. SoFi's member count grew to about 14.7 million from roughly 10.9 million. That is significant. A financial platform with nearly 15 million members has crossed from concept into scale, and the long-term opportunity may still be much larger. A digital financial platform can expand into banking, lending, investing, credit cards, insurance, crypto, brokerage, financial planning, student loans, personal loans, mortgages, and technology services. The more members it has, the more opportunities it has to cross-sell. The more products each member uses, the stronger the relationship becomes. The stronger the relationship becomes, the more valuable the platform becomes. This is the ecosystem logic. Traditional banks historically had the customer relationship because they held deposits, issued loans, and became the default financial home. But many traditional banks are slow, expensive, fragmented, and poorly designed for younger digital-first users. SoFi is trying to become the modern financial home for a new generation. If it succeeds, the upside can be enormous. This is why the comparison to Palantir appears in the source. The point is not that SoFi and Palantir are the same business. They are not. Palantir is a data and software platform. SoFi is a digital financial platform. The comparison is about market perception. Palantir was doubted for years. Many investors looked at the business and did not understand the long-term operating leverage and platform potential. Then, once growth, profitability, AI relevance, and institutional adoption became clearer, the market repriced it dramatically. SoFi may be in a similar psychological phase. The market sees risk, the long-term investor sees a platform, the market sees a banking-related company with volatility. The long-term investor sees a digital financial ecosystem that could one day compete meaningfully with legacy banks and fintech companies. That is the asymmetric possibility. SoFi is not risk-free. That must be said clearly. Any company connected to banking and lending carries risk. Loans can go bad. Credit cycles can deteriorate. Funding costs can rise. Regulators can tighten. Management can misjudge risk. A severe recession can damage credit performance. If a financial institution becomes too aggressive, bad things can happen quickly. The source mentions the worst case risk. Something goes wrong in the banking side. Leverage becomes a problem, and the equity can be impaired severely. That is why position sizing matters. You never allow one financial stock, especially a high-growth financial stock, to become so large that it can destroy your life if the risk case appears. But risk does not eliminate opportunity. The best opportunities often include risk that the market can see but may overprice. If SoFi continues executing, continues adding members, continues expanding products, continues improving profitability, and continues building trust as a financial platform, the stock can become much larger over time. The source suggests a path toward a $50 stock within 5 years and potentially much higher long-term. Whether those exact numbers happen is uncertain, but the direction of the thesis is clear. A platform with strong revenue growth, improving profitability, member growth, technology infrastructure, and a long runway can be worth far more in the future if execution continues. That is the key condition: execution. Anthony Noto and management matter. Strategy matters, risk management matters, credit discipline matters, product expansion matters. The company has to keep scaling without taking reckless balance sheet risk. This is the difference between a great fintech platform and a dangerous lender. SoFi must keep moving toward an asset-light, fee-driven, platform-oriented model while managing lending risk carefully. If it does that, the market may eventually stop valuing it like a risky lender and start valuing it more like a financial technology platform with long-term operating leverage. That is where the re-rating could come from. One underappreciated part of SoFi is the technology platform, including Galileo. The source notes that platform accounts had been declining for a couple of quarters, then reversed and grew again. That matters because it suggests the technology segment may be stabilizing or improving. If SoFi is not only a consumer-facing financial platform but also a provider of technology infrastructure for other financial services companies, then the opportunity broadens. A consumer bank can grow. A technology platform can scale differently. The combination is what makes the business more interesting. Again, the question is not whether the stock went down today. The question is whether the long-term business is improving. Members are growing, revenue is growing, profitability is improving. The product ecosystem is expanding. The technology platform may be stabilizing. The The company is becoming more relevant. Those are the signals. The stock price is the noise. If your time horizon is long enough, but not all declines are buying opportunities. Sometimes a stock falls because the thesis is breaking. That is why the investor must be honest. If credit quality deteriorates severely, that matters. If member growth slows sharply, that matters. If funding costs overwhelm income, that matters. If management becomes reckless, that matters. If regulation limits the model, that matters. If technology platform growth fails repeatedly, that matters. If dilution becomes excessive, that matters. A long-term investor should monitor these risks, not ignore them. Conviction is not blindness. Conviction is knowing what you own and knowing what would prove you wrong. Now let us put SoFi into the broader market context. The old banks are enormous. JP Morgan, Bank of America, Wells Fargo, and others have scale, deposits, regulation, customer relationships, and deep institutional trust. They will not disappear, but they also carry legacy systems, branch networks, old technology, and customer experiences that younger users may not love. Fintech companies attacked pieces of the financial stack: payments, investing, crypto, lending, budgeting, neobanking. SoFi is trying to aggregate many of those functions into one financial membership platform that is ambitious. If it works, the company can take share from both legacy banks and fragmented fintech competitors. The addressable market is huge. The difficulty is execution and trust. People do not move their financial lives lightly. They need a reason: better rates, better products, better digital experience, better loans, better investing, better rewards, better convenience, better brand trust. SoFi must keep proving that it can be a primary financial relationship, not just a place someone uses for one loan or one product. The member growth suggests progress. The long-term question is depth. How many products per member? How profitable is each member over time? How sticky are deposits? How low is customer acquisition cost relative to lifetime value? How stable is credit performance? How much revenue comes from fee-based services versus balance sheet risk? These are the questions that determine whether SoFi becomes a major financial platform or remains a volatile growth lender. This is why the opportunity is large but not simple. Now, the market's reaction to SoFi also reveals an emotional truth. Investors often say they want a great growth stock at a discount, but when the discount comes because the stock is down sharply, they become afraid. They want the opportunity only if it feels safe. But if it feels safe, the price is usually higher. That is the paradox. A stock like SoFi can be easier emotionally to buy when it is rising and harder emotionally to buy when it is falling. But the risk-reward may be better after the fall if the fundamentals remain strong. The discipline is to separate price action from business action. If the business is improving and the stock is falling, study it. If the business is weakening and the stock is falling, avoid or reduce. If the business is improving and the stock is rising, decide whether valuation still makes sense. If the business is weakening and the stock is rising, be careful. This simple matrix prevents emotional mistakes for SoFi. The source ES view is that the business improved even while the stock was punished. That is why it becomes a candidate for long-term opportunity. Now let us connect everything. Meta is spending aggressively, but the return path is not clear enough for investors right now. Amazon is spending aggressively, but AWS and advertising make the return path clearer. Google is spending aggressively, but Google Cloud growth justifies the market's tolerance. Microsoft is spending aggressively and Azure remains strong. Though the acceleration is less dramatic, the chip suppliers, including NVIDIA, AMD, and Micron, may be the most direct near-term beneficiaries of the AI CapEx arms race. Cheesecake Factory shows that not every attractive business needs to be part of AI. A stable, growing restaurant company with dividends and expansion potential can still be valuable. SoFi represents the high-growth financial platform opportunity that the market may be punishing too harshly relative to the long-term trajectory. This is the actual structure of the market today. AI spending is creating winners and pressure points. Cloud revenue justifies some spending. Unclear spending creates skepticism. Chip suppliers collect the capital. Traditional growth companies still matter. Boring profitable businesses still matter. And selective punished growth names may offer asymmetry. The investor's job is not to worship one theme. The investor's job is to allocate capital where the risk-reward is best. That may mean owning some AI suppliers. It may mean owning platform companies selectively. It may mean trimming or holding expensive winners. It may mean buying great businesses when the market overreacts. It may mean owning a stable dividend compounder. It may mean taking a carefully sized position in a high-growth fintech like SoFi. The portfolio should reflect the machine, not the excitement. Now, what would I watch going forward for Meta? I would watch CapEx guidance, expense growth, user engagement, AI monetization, AD pricing, and whether Zuckerberg begins explaining the return path more clearly. If spending keeps rising without clearer business leverage, the stock can remain pressured. If the market sees a path from AI spending to revenue and margin expansion, the stock can recover. For Amazon, I would watch AWS growth, advertising growth, operating margin, and whether infrastructure spending continues translating into cloud acceleration. As long as AWS growth remains strong, the market will likely tolerate heavy investment. For Google, I would watch Google Cloud growth, search monetization in an AI world, CapEx discipline, and whether operating income continues growing faster than revenue. If Google Cloud keeps scaling rapidly, the AI spending story remains credible. For Microsoft, I would watch Azure acceleration, AI monetization across enterprise products, Copilot adoption, and the pressure from memory and infrastructure spending. Microsoft has one of the strongest enterprise positions in the world, but valuation and growth expectations must be respected. For NVIDIA, AMD, and Micron, I would watch the durability of AI infrastructure demand. The current CapEx signals from big tech are strong, but eventually investors must ask when customers moderate spending whether supply catches up and whether margins remain high. For Cheesecake Factory, I would watch unit growth, restaurant margins, labor costs, food costs, dividend stability, and expansion of newer concepts. The story is simpler but still requires execution. For SoFi, I would watch member growth, product adoption, credit quality, deposit growth, net interest margin, fee-based revenue, technology platform accounts, and profitability. The long-term opportunity depends on scaling without taking excessive risk. This is how a serious investor thinks, not one headline, not one price move, a checklist of drivers. Now, there is also a larger lesson about earnings season. Earnings season is not only about whether a company beats or misses expectations. It is a window into capital allocation, operating leverage, management credibility, and where the economic machine is moving. When several mega-cap technology companies all raise AI spending, that tells you something. When cloud growth accelerates, that tells you something. When some companies get punished for spending and others get rewarded, that tells you what kind of spending the market trusts. When a fintech posts strong growth and gets sold off, that tells you there may be a perception gap. When a restaurant company shows margin improvement and stable execution, that tells you that simple businesses can still work. Earnings season is a map. Most people only look at the red and green dots. A disciplined investor reads the terrain. Now, let me make the key principle simple. The market is rewarding clear ROI and punishing unclear ROI. That is the central theme. Amazon spending has clearer ROI because AWS demand is accelerating. Google's spending has clearer ROI because cloud growth is exploding. Microsoft spending has partial clarity through Azure and enterprise AI, though acceleration matters. Meta spending has less visible ROI right now, so the market is skeptical. The chip suppliers have direct ROI because they are selling into the spending wave. SoFi has strong operating momentum, but the market is still debating how to value the risk. Cheesecake Factory has a straightforward operating model with less AI spending uncertainty. This is not complicated. It is cause and effect. Where does the dollar go? What return does it generate? How fast can investors see it? How much risk is attached? That is the investing problem. Now, if I were thinking in a Ray Dalio style system, I would say the economy is a machine made of spending, income, credit, productivity, and expectations. In this market, AI is changing productivity, expectations, which changes capital spending, which changes revenue flows, which changes margins, which changes stock prices. The companies receiving the spending can benefit first. The companies doing the spending must prove the return later. The companies with unclear return paths are punished. The companies with clear return paths are rewarded. The companies outside the AI spending race can still be attractive if they produce reliable cash flow and growth at reasonable valuations. That is the machine. Once you see it, you do not get lost in the noise. You can watch Meta fall and not assume the company is dead. You can watch Amazon rise and understand why. You can watch Google rally and know the cloud line matters. You can watch Microsoft remain more mixed and understand Azure expectations. You can watch NVIDIA, AMD, and Micron gain confidence because big tech spending is flowing into them. You can watch SoFi sell off and ask whether the market is missing the long-term platform story. That is the disciplined approach. Now, there's a final point about time horizon. If your time horizon is a day, earnings reactions matter enormously. If your time horizon is 5 to 10 years, the question is much larger. Which companies will be more valuable in the future? Which management teams allocate capital? Well, which businesses have expanding markets? Which companies have competitive advantages? Which stocks are priced attractively relative to those future cash flows? For Meta, the long-term answer may still be positive, but the short-term spending pressure is real. For Amazon, the long-term answer remains very strong if AWS and advertising continue scaling. For Google, the long-term answer is strong if cloud and AI protect the core franchise. For Microsoft, the long-term answer is strong if enterprise AI monetization justifies massive investment. For the chip companies, the long-term answer depends on how durable AI infrastructure spending proves to be. For Cheesecake Factory, the long-term answer depends on execution, restaurant expansion, margins, and capital returns. For SoFi, the long-term answer depends on whether it becomes a dominant digital financial platform. That is the real analysis. Do not be distracted by a single day. Use the single day to identify where the market may be overreacting or correctly adjusting. Now let us focus again on SoFi because that is the main asymmetric idea. A stock that falls 15% after showing very strong growth creates a question. Is this a falling knife or is it a gift? The answer depends on fundamentals. If the company is growing revenue above 40%, doubling EPS, increasing members significantly, expanding net income, improving fee lines, and showing signs of stabilization in technology accounts, then the fall deserves study. It does not deserve blind buying, it deserves study. If the market is worried about credit risk, valuation, macro, or expectations, those concerns must be examined. But if the long-term platform thesis remains intact, then a sell-off can create a better entry point. This is where great long-term returns often come from. Not from buying perfect companies on perfect days, from buying strong companies when the market is focused on short-term fear and not fully valuing long-term expansion. SoFi could become one of those cases. It could also fail to execute, that is why risk control matters. But the opportunity is real enough to study seriously. If SoFi continues adding millions of members, expands products, takes share from legacy banks, grows fee income, manages credit well, and becomes a trusted financial platform, the current market cap may look small in retrospect. If it fails on credit risk, profitability, or trust, the stock can disappoint badly. That is the range of outcomes. Asymmetry exists when the upside outcome is large, the downside is understood, and the position is sized so that the downside does not destroy the portfolio. That is how I would frame SoFi, not as a guaranteed next Palantir, as a high upside platform candidate that the market may be underappreciating after a short-term sell-off. Now, why does this matter? Because the biggest opportunities often come when a company is transitioning from being misunderstood to being recognized. Palantir went through that. Many great growth stocks go through that. At first, the market sees complexity and risk. Then execution continues. Revenue grows, margins improve, the product becomes harder to ignore. Customers expand, analysts adjust, institutions return, the multiple expands. By the time everyone agrees, the easy money is often gone. The challenge is buying before consensus, but not before evidence. Evidence matters for SoFi. The evidence is member growth, revenue growth, profitability improvement, and platform expansion. That is why the stock is worth attention. Now, there is one important caution. Do not confuse a company you like with a position size that is safe. Even if SoFi is a great opportunity, it is not the kind of stock most people should let dominate an entire portfolio. Financial companies can surprise investors. Credit cycles can change quickly. High-growth fintech can be volatile. Position sizing is the difference between intelligent risk and dangerous concentration. If the stock becomes a multi-bagger, a moderate position can matter. If the thesis breaks, a moderate position will not ruin the investor. That is the balance. The goal is to be exposed to upside without being destroyed by downside. This applies to every stock discussed. Meta, Amazon, Google, Microsoft, Cheesecake Factory, SoFi, Nvidia, AMD, Micron. No company is risk-free. The best investors do not only ask what can go right, they ask what can go wrong and whether they can survive it. Now, let us end with the most important principle. Earnings season is noisy, but long-term value is built by focusing on the trajectory. A stock can be down today and still be on the right long-term trajectory. A stock can be up today and still be expensive. A company can spend heavily and be making the right strategic decision. A company can spend heavily and be destroying future returns. The investor must judge the quality of the spending and the visibility of the payoff. In the current market, AI CapEx is the central force. It is creating direct winners among chip and infrastructure suppliers. It is creating pressure on platform companies that must justify spending. It is separating businesses with clear cloud monetization from businesses where the return is harder to see. At the same time, outside the AI arms race, disciplined growth businesses and punished platform opportunities can still matter. That is why this is not a one-stock market, it is a capital flow market. Follow where the money is going. Follow which companies convert spending into revenue, follow which companies protect margins, follow which companies are punished despite strong long-term improvement, and always remember that price is what you pay, but the business trajectory is what you own. Today's sell-off can be tomorrow's opportunity. Today's excitement can be tomorrow's overvaluation. The difference is the work. Do the work, read the income statement, understand the cost structure, track the capital spending. Identify the revenue line that justifies the investment. Watch member growth. Watch operating leverage. Watch management discipline. Watch valuation. That is how you survive busy times in the market, not by reacting to every after-hours move, by understanding the machine beneath the move. And if you understand that machine, you can see why SoFi after a sharp decline may be more interesting, not less. You can see why Meta may be great long-term but messy right now. You can see why Amazon and Google are being rewarded for cloud acceleration. You can see why Microsoft remains powerful but must show AI return. You can see why Nvidia, AMD, and Micron may keep receiving the money. You can see why Cheesecake Factory remains a simple but attractive compounder. And you can see why the next great opportunity may not be the stock that went up the most today, but the company the market is still learning how to value. That is where long-term investors should focus. Not on noise, on trajectory. Not on emotion, on cause and effect. Not on the headline, on the flow of capital. That is how fortunes are built.